everyone, welcome back to the channel. I appreciate you joining me today. So today we're going to talk a lot about asset location versus asset allocation. Might seem like a minor nuance in words, but I promise you, if you know the difference between the two, it can help save you a lot of money in taxes. Okay, now before we dive in, like, subscribe, comment. I love comments. And without further ado, we'll dive straight in. Okay, so this topic, asset allocation versus asset location. It's a big topic. It's very fun to talk about. No one likes paying a lot of money in taxes. So this is a topic that is very relevant to many. But before we dive headfirst into this topic, I want to give a little bit of context on the investment options that you and I have, the common investment options, because this is going to play into this allocation versus location discussion. So, the way that I view things, there are 9 investments out there that you and I can place our monies in. And I'll pull them up here on the screen. There are certainly more than 9, but 9 is commonplace. Okay, these are the investment options that everyday people have. It's commonplace. Majority of people, including myself, throw their money in one of these 9 spots, or multiple of them, or even all of them. That's not a bad idea. So let's start. 3 investments out of the 9. We have large companies in the United States, we have medium-sized companies, and then we have small companies. Okay, so the large companies are Nvidia, Apple, Amazon, all those companies like you and I both know. Medium-sized companies, they haven't quite hit it big like Apple and Amazon yet, but they're pretty established. They're looking pretty good. And then the small companies, they're beyond startup mode. So they are established, but if we're looking at it relative to like Apple, they're flies on the radar. Now, side note for a second, there can be some risk with smaller companies, but the past century, this is the highest returning investment that you and I can place our money in. Okay, so 3 of the 9. Let's go down the list. Now we have companies that are domiciled overseas. And there's 2 categories here. There's companies that are in emerging countries, and there's companies that are in developed countries. Okay, so we're at 5 investments. Now we have real estate as number 6 investment. We have cash or cash alternatives as number 7. Yes, you place in your money at the bank in a savings account, gaining some interest. That is a place to store your money. We have commodities, so oil, precious metals, those sorts of investments. And then last but not least, we have bonds. Okay, and bonds are a safer type of investment, which we'll talk about here in a second. But those are the 9 in no particular order. Those 9, however much money you have in each of those 9 investments, that is how you're allocated. Okay, and many people see kind of like a colorful little pie chart that shows, hey, this is how your net worth is allocated. You have this much in real estate, you have 19% of your net worth in bonds, you have 5% in cash, 50% in large companies in the United States. This is how you're allocated. This is what the pie looks like. Okay, now each of those 9 investments, they act a little bit differently. And what I mean by that, I'm going to use an analogy here. So this analogy, I just got done furnishing a new office here, so it's top of mind for me. I feel like I've been playing interior designer for like a couple months. But let's say you get a new house, okay? And that new house, you buy all the appliances and furnishings that you need. The couch, the fridge, the TVs. You even buy a new mattress, bed set. And you say, okay, this is what I'm doing. I'm throwing the mattress in my kitchen. I'm throwing the fridge in my bathroom. The couch is going in my study, and that's how it's going to be. That doesn't make much sense to us, right? That's not how you organize your house. I mean, maybe it is. Maybe you're in a tiny home or something where you gotta shove everything together. But let's just say it's a normal house. There might be a more optimal, efficient setup, right? And it's the efficient setup that most people abide by. They don't try to reinvent the wheel. They stick their mattress in their bedroom. Their refrigerator does not go in the bathroom, it goes in the kitchen. They got their couch, they might put that in the living room, right? And so on, so on. This is the most optimal living quarters that people are just abiding by, right? It makes sense. Your investments are no different, okay? Certain investments act in certain ways, and you don't want to hold specific investments in specific locations. And when I say locations, I'm talking what the account is. Okay, you have different types of accounts. I'm going to talk about the three most common types of accounts, but there's certainly more than this. You have Roth accounts, Roth IRA, Roth 401k. You have tax deferred accounts. So an IRA and a traditional 401k. Okay, so Roth versus traditional. And then the third onset of accounts that I'll talk about that's pretty common is a taxable investment account. You can move money in and out of it, but you're going to pay capital gains taxes at the end of the year every time you do that. But the money's liquid, right? It's not like the 401k and the Roth accounts that you don't touch it until you retire. This account you can pull money in and out of. But important thing to make note of, because you can pull money in and out of that thing, any income or interest or dividends that spit off from the investments that you have in that account will be taxed that year. Okay, so you're going to be paying, even if you don't pull money out of it, but you have an investment that spits off passive income, you're going to pay taxes on that income, even if you reinvest it. That's important to know. Okay, so let's compare the two most common investments. We have stocks and bonds. Stocks, generally speaking, appreciate at a pretty good clip, and they don't spit off a ton of passive income. Okay? They appreciate without a ton of passive income. Bonds, it's the complete opposite. Bonds appreciate at a more steady pace, and it spits off passive income. A bond, for those of you who don't know, is a stock. You and I both know we invest our money in a company, said stock, maybe it's Apple, let's say it is. We invest our money in Apple, and Apple is worth X amount today. We're investing our money in Apple because we think it's going to be worth more in the future. Okay, and we're capitalizing on those returns. So you invest your money in Apple, you're believing in the company that's going to go up in value, and you're going to get returns for making that investment if it does go up. A bond is the opposite. So let's take that same company, Apple. Let's say, I don't know what iPhone they're on right now. Let's say it's the iPhone 20. I don't know. Let's say they're doing R&D, research and development for the next iPhone 20. They don't just snap their fingers and have money for this research and development. I know they're a big company, but that's not the way it works, right? They're a public company, so what they do is they get funding, public funding. And what that means is us public folks can provide the funding to Apple for them to do some research and development for the iPhone 20. What that looks like is they say, hey, we need $50 million. We're going to the public. Give us this 50 million, and all these people get their funds together, and you put all of these people's monies together, and that makes up the 50 million. Maybe I gave them $1,000 of the 50 million that they needed, and everyone else is doing the same. Okay, but if I give them 1,000, what a bond is a bond is saying, hey, in X amount of time, we're going to pay you back that $1,000. But along the way, we're going to give you interest because you lent us your money. Kind of like how a mortgage works, right? But it's the opposite. We take money from the bank, they lend us the money, and we pay them interest with the money back over time. Bond works the same way. So a bond, when they pay us interest back, that interest is taxed if it's held in a taxable investment account, because that's viewed almost like passive income where that money is being spit off from the investment that you gave Apple. And if you have it in a taxable investment account, you're going to pay taxes on it next year. It's called a 1099. Some of you might be familiar with it, and it stinks. You want that 1099 to be as close to zero as possible. But that's the way it works. So if you have something like bonds or real estate acts the same way, it spits off passive income. These types of investments make no sense most of the time to hold in taxable locations. Because why? You're going to have to pay taxes every single year. Whereas if you just decided to hold those bonds or real estate or other types of similar investments in something like a tax deferred account, you pay no taxes each year. Okay, that passive income or interest is reinvested and the taxes are deferred into the future. It's awesome. So things like bonds, real estate, those types of investments, it might make sense to hold them in places that are tax deferred versus things that appreciate to a high degree, maybe like large or small companies in the United States. You might hold that in a taxable investment account or in a Roth location, but each of these 9 investments that I referenced at the beginning, you want to pay attention to where they're held. That is important because where they're held can greatly impact the amount of taxes that you pay each year. And if you're paying more taxes each year for no reason, that's less money that you have down the road. Okay, so hopefully you get something out of this. If you want to learn more about asset location versus asset allocation, hit our website, reach out to me. I love this topic. There's a ton of visuals to go along with it, but hopefully you got something out of it. Like, subscribe, comment, and I'll see you next time.